Hey everyone, thought I might do a quick video on this ABC practice question. It's probably a really good summary for the balance sheet section overall. I know I haven't done a video this week, but I kind of thought I might lay low with the content given that with everything going on, there's a bit of emotional turmoil and it's been probably a tough week for everyone out there. So I just thought I might give us a little bit of a break, a breather, so we can deal with life and then try and get back into it when we get our mindsets straight. So what I've done is I've created a Word document to summarize the journal entries for all the transactions for this question, ABC, PTY, LTD. I know it's an additional question, it's not required in the readings, but it's always great to do all these additional questions. Practice makes perfect. I always found for me doing my chartered accountancy and my accounting business degree is that reading the text is really, for me, wasn't a great help. It was doing the questions, and I would do the questions, and a lot of the time I'd actually read the answers first and work backwards so I could understand why the answers were how they were, if that makes sense. You should always attempt the question first and then go back, but I would always have the answers and the question at the same time. I'd like to look at it all, and that's how I learn. I couldn't stand reading textbooks, to be honest. So I thought I might just quickly go through the 10 transactions that occurred and just go through the journal entries. As I said, I have created actually a Word document. So when I upload this video into the thing, I also have this Word document. So look at the Word document while I talk and I'll go through it. I'll try and do it quick, but give you all the information you need. So the first transaction is the owners withdrew equity in the form of cash of $46,000. Pretty easy. Equity goes down, cash goes down. Equity is obviously credit, cash is an asset. They've got different debit and credit natures, so both the accounts are going down. Actually, before I quickly go through anything more, I quickly just want to, sorry, I should have done this first, is in this worksheet, you've got opening balances. These are just found from the previous year's balance sheet. So you just input them. So it's as at 30th June 2016. So they're your opening balances. So you can go and fill it in through that. And as you remember there, assets equal liability plus owner's equity. I also did want to mention in the equity, there's a thing called retained earnings. This is basically a P&L. So just summarizes your P&L. So what you'll see is in my journal entries, when it's either a revenue and expense, it will show up in your worksheet as a retained earnings. Okay, hopefully that makes sense. All right, sorry, I should have done that first, but we've already gone through the first part. So the second one is the premise was rented at an annual rate of 40 grand. During the year, rent of 50 grand was paid to the owner of the premises. So we've actually received 50 grand cash, we've paid rent of 40 grand, and we have got prepaid rent of 10 grand. So that's our journal entry. We've got cash coming in, which is 50 grand. Then on our credit side is the prepaid rent, which is a current asset. And then we've got the revenue coming in, which we can show on our books. Now, we don't book the full 50 grand as revenue straight away because it's not earned. Okay, so our revenue is 40 grand per year. So that's what we've earned. The 10 grand is, say, the first quarter. So we'd book that 10 grand in the next year. That's why it's called prepaid rent. So that prepaid rent will flip to actually revenue in the next financials. Rates on the premises were paid for the year for the period 1 April 2017 to 31st March 2018 for the amount of 6 grand. So this is a good time to kind of draw timelines. This is how I learned it. You draw a timeline here. This is, so from here, we're starting, let's say, 1 April, and we've got our time frame of the end of the year, 30th to the 6th, and then here, this is the 31st of March. So our financial year is here. So we're working on this. So you'll have the 1st of the 7th to 6th. So this year, this is our actual expense, and this is prepaid section. All right, prepaid, this is our expense here. Hopefully that makes sense. So for me, drawing timelines when you didn't quite get things really helps. So it breaks it down. So we paid rates, so of $6,000. So it's still going down by $6,000. But what we can book in this year is 3 months. So April, May, June, 3 months, because the financial year we're doing is 2016-17. Okay, so if it's $6,000, we go $6,000 divided by 12 to get our monthly rate cost, which is $500. So 3 by 500 is $1,500. So we can book this to the rate expense. The rest of it is for the next financial year. So next year we book it, and that is for this financial year. It's prepaid because it's in the next year's, because it's not really incurred. It's an expense we paid, but like we're prepaying it for next year, if that makes sense. So in the following year, we would then flip that into rates expense. Hopefully that makes sense. Then the business uses the reducing balance method of depreciation for non-current assets at the rate of 20% each year. If you didn't know, there's two main ways we can depreciate in accordance with the ATO, which is the Australian Taxation Office. One is straight line, so it's basically looking at your effective life. So if we've got something, say, for $100,000, it's a 5-year life period. Sorry, we do $100,000 divided by 5, which is 20,000, and that's our depreciation for the next 5 years. Whereas the diminishing value is 20%. So if we've got $100,000, 20%, that's $20,000 for the next year. Then the following year, it's not going to be the same amount because we've now got 80,000 left of the asset. Then we apply the 20%, so then it's going to be 16,000. So you can see it's going to diminish our depreciation. So we max our depreciation the first year, and it will get less and less. So it'll go 20,000, then 16,000, then whatever. I can't be bothered doing the maths, to be honest. So our current non-current asset in the per the balance sheet as at the 30th of the 6th, 2016 is machinery. Its current value is at 50,600, and there's depreciation which we need to take out of 12,000. So that leaves us with the value of 38,600. So that's what we calculate our diminishing depreciation on. So we apply 20% to that. Sorry, which is 7,720. Let me have some water. All right, that's a lot. So we are debiting our depreciation expense. That's a P&L item, and then we are crediting accumulated depreciation. So it's a non-current asset. We credit it because it's a bit of a contra asset. I won't go into that. You don't need to know that at this stage. Okay. Whew. Next question. Wages totaling 45,000 were paid during the year. As at the end of the year, the business owed $2,620 of wages. So first thing to note is we've got account balance of accrued wages of $3,400. So we need to nil that account out because basically it's accrued wages, but in that 45,000, because we paid wages for the year, it kind of got booked in that lump sum. So we need to clear out the account. So we can do that. The way we do it is we debit accrued wages to clear out the account, and we are crediting retained earnings. It's kind of in the wages expense. So we are reducing your wages down by 3,400. Then we've got that 45,000. So we are paying cash for wages. So we are debiting the wages, and our cash is going down by 45,000. Now, we've got then accrued wages for at the balance at the end of the year is 2,620. So basically our accrued wages account was 3,400. We had to bring it down, and now we're bringing it up for the end of the year to 2,620. So timeline thing. Okay, up here, 3,400. During the year, we pay our wages, and then at the end of the year, we've got a bit owing, which is 2,620. So wage expense is, we debit wage expense and credit accrued wages. So that then shows the liability account at 2,620. Now, I just wrote a note. Just a quick definition of what accrued is. So accrued, it means something that you gain as a debit or expense, but you have not yet paid for. So it's basically debt that you have to pay. All right, so it's like, could be employees working, but you haven't paid them yet. All right, 6, so inventories totaling 260,000 were purchased on credit. So this is accounts payable. So something we have to pay back. So we debit inventory because we're getting that straight away, and then accounts payable is something we owe. It's a liability, we credit that. Pretty simple. Sales revenue on credit totaled 432,000. So we have to, so basically that means that we are selling goods, but we're not receiving cash for it. It's on accounts receivable. So that means in the, say, 30 days, they have to pay us back for it. So the account is, we debit accounts receivable, credit sales, which is 432,000. Now, because we're obviously manufacturing some kind of goods, there's inventory involved. So we've got cost of goods sold. So we've also got another journal entry we need to do, which is debiting cost of goods sold and crediting inventory for 264,000. So that just means the inventory we had on asset, we obviously are selling a portion of that to sell and go out the door. So inventory gone, that's our cost of goods sold for whatever revenue we're selling. So I don't know, purple cream. So your inventory is the actual physical product. Your revenue might be $10, but your product to make might be $5. So then you can see that gross profit margin is $5. Simple, if you think about it that way. Cash sales totaled 89,000. So we've got cash. This is very similar to the question above, question number 7, but it's cash, not accounts receivable. So we go debit cash, credit sales for 89,000. And again, we've got cost of goods sold for 60 grand. So we go debit cost of goods sold, credit inventory for 60 grand. All right. 9, nearly there. Receipts from trade receivables totaled 376,000. So remember before how I said in 30 days people are going to pay us back? These are these people. So they are paying us back. Our cash is going up because we're getting money from it, which is 376, and we're reducing our accounts receivable by 376,000. So money's coming back in. And then the last one, thankfully, my voice is getting sore. Payments to trade and payables totaling 212,000. So again, as before in, what was it, question, oh God, I can't even see. Number 6, where we purchase stuff on credit. So this is us basically paying a portion of it back. So we're paying 212,000. So our accounts payable, because it's a liability, we're debiting it. So we're bringing the account down, and because cash is going out, we're paying for something, cash is going down. It's our assets, debit nature, so it's going down because we're crediting it. All right, this worksheet hopefully explains things fairly well. I think it's pretty easy. Any questions, post below and I'll get it to you. But yeah, hopefully that kind of helps succinct everything, make everything understandable. Any questions, post below. Hope everyone's doing well. Bye.